Welcome to Expert Conversations Beyond, where Chatham's experts break down important trends and themes with capital market participants. I'm Kern Roberts, and I'm a Managing Director and Head of Global Hedge Accounting Advisory here at Chatham.
I'm Benoit de Bénazé, Managing Director covering financial sponsor and corporate at Chatham in Europe. We are excited today to welcome you to another episode of Expert Conversation Beyond. Today we will be discussing financial risk in merger and acquisitions.
There are a wide range of questions we're seeing from our clients in this area. How do you deal with FX risk, IR risk? How do we pre-hedge? Benoit, are you ready?
I'm ready.
Let's get started. Benoit, let's talk about M&A. What are you seeing in terms of M&A activity amongst PE sponsors, corporates, our broader client base?
So we've seen few interesting trends when it comes to merger and acquisition for financial sponsor and corporate. First, in terms of like deal activity, the sponsor-led M&A is catching up with corporate. So according to the latest data, now sponsor activity represents roughly 40% of like total deal volume, where it was close to 25% a decade ago. So this activity is definitely catching up with corporate. In terms of dry powder, because of lower fundraising in the past few years, slower exit on financial sponsor, it has impacted down dry powder for financial sponsor, where for corporate, it's slightly up. Thinking in terms of activity, on the private equity side, main focus for the industry has been specific sector such as technology, healthcare, services, also taking like opportunities from take private to play some valuation gaps, and also significant activity on like buy and build. Where for large corporate, the main activity has been to focus on core investment and disposal or carve out of non-core or like non-strategic assets, and sometimes in partnership with private equity funds.
And just to dive into some of the terminology there, just make sure that everyone's sort of thinking about it the same way. When we talk about dry powder, we just mean unallocated capital, right? So we're saying, okay, there's less unallocated capital than there was, but there is still a reservoir of unallocated capital.
Correct. And in the past decade, what we've seen on private equity, it's a huge accumulation of dry powder. But just the trend we saw in the past 2 years, it's slightly down compared to what it used to be.
So down, but still high.
Correct.
And given the kind of deals and exits that we're talking about, what kind of risk factors are we seeing? What are the big things that people are worried about when they're entering into these type of transactions?
So we see mainly two big financial risks our clients are facing when they are involved in like merger and acquisition, mainly FX and interest rate. And at the moment, there is still uncertainty around like markets and still volatility. Looking at FX, so in 2024, following the US election, euro dollar dropped by nearly 5% in the space of like 2 weeks.
Yeah.
At the time, the market was pricing such an event as like 1% probability. So it means low probability of occurrence, but potential significant impact for like anyone involved in a cross-border M&A with FX risk. When it comes to interest rate, again, looking at 2022 and partially like 2023, where financing cost nearly doubled because of base rate for like the main currencies for financial sponsor, we estimated the impact of this increase in interest rate to have a negative impact of like 3 or 4% on IRR of a typical 5-year leverage buyout, which is significant when you think those type of investors are targeting 20-25% return. Yeah. And again, with what happened in 2024, with like the delay of like rates cut coming from the main central bank, where the market was pricing several rates cut over 2024, there is definitely uncertainty. What it means also for investors is like you can't rely on forward curve or on like bank forecast or like economic forecast, because they are very poor predictor of where the market is going to be.
That's interesting. 'Cause when I kind of think about particularly sponsor-backed deals, when I think about in my sort of simple-minded kind of idea of how a sponsor-backed deal works, you have this expert private equity firm coming in. They're investing in a business. What they want to do is operate that business more efficiently, increase its value. And this isn't always the story, but this is kind of quite a typical story. Increase its value by increasing its operating efficiency. And actually, when you're thinking about increasing the operating efficiency of a business, it's quite small margins of operating improvement that you might be looking at. And if the whole pricing of your transaction is blown out by a big move in FX rates, that really undermines the whole viability of that deal, right?
Exactly, and what we have seen, which add uncertainty also on those merger and acquisition, is increase scrutiny from like regulators. So if you
Mm,
think about European Commission,
yeah,
UK CMA, or like US FTC, in certain sector,
mm,
again, healthcare, technology,
yeah,
energy, where we still see on average deals that will complete in like a 3 months time frame.
mm,
It's not uncommon to see deals that are going to take an additional 6 months, 1 year. We've worked recently on few transactions that have potential long stop date of above 1 year. So it
yeah,
means additional risk for investor. And back to your point, where it's also important to understand your sensitivity as an investor, because a 5% FX move has not the same impact for your return if you are a real estate investor
mm,
seeking lower return than like a typical private investor. So
yeah.
you really need to really need to understand those sensitivities to make the decision on like what's the best strategy and when's the best time to hedge your risk.
Yeah, and that's an interesting point, the increased regulatory cycle in terms of getting a lot of these things approved. Because if I'm thinking about what I'm really scared about as an investor is I'm scared about volatility anyway, in terms of particularly FX risks, interest rate risks. But I'm particularly scared about black swan events, really big moves. And I guess if I've got a 3 month period where I'm exposed to the risk of a black swan event, I feel very differently than if it's like a 9 month period. I've got almost 3 times the exposure in terms of the probability of something that's quite a big move in the market. And I guess we've also seen a lot of it's become a cliche almost that black swans are more common, and we have these sort of fatter tails on the distribution in terms of those kind of events.
Exactly.
What are some things that our audience members should consider when it comes to capital structures for these deals? And how does that play into managing risk?
Yeah, so capital structure is a very interesting topic. We have more and more discussion with our client. And so to put things into context, when it's relevant is either when we have investor buying a business or combining business with exposure in like different currencies. And the question is like, how should I raise my capital? And thinking about like debt currency mix or like
Yeah.
debt currency split. Where it's very interesting is like we have those discussions very early stage, like
Mm.
at due diligence process. And we work very closely with our investment banking team at Chatham,
Yeah.
because there are two ways you can raise your capital in a way.
Mm.
One that is pure financing, and another one is like a combination of like financing and derivatives.
Yeah.
And you have also multiple metrics that like an investor can optimize the capital structure.
Yeah.
So you could think, I want to reduce my leverage risk volatility. I want to protect my equity value. I could look at like earning per shares if I'm a listed entities. So there are multiple ways where you can optimize those metrics. They will
Yeah.
give different answer in terms of like how to raise capital. So for investor, it's critical to understand like the pros and cons of like the different approaches, the cost, the benefit, and what's the setup you need to implement those solutions. In addition, in certain markets, so if we think about like the UK market, where sterling financing in term loan has its limit in terms of like how much capital you can raise, we see for very large transaction the need to go after euro or like dollar financing
Yeah.
and to use derivatives such as like cross currency swap to create synthetic debt in sterling.
Yeah.
And that has been a trend that we have seen in the past 5 years, and it's continued to grow.
And it just ends up being more efficient than raising naturally in sterling, right? To raise in that more liquid market and then swap it back with a
In
derivative.
that particular case,
Yeah.
it's actually more attractive to look at
Mhm.
like synthetic sterling financing
Mhm.
using derivatives plus euro financing than to
Yeah.
raise directly like sterling.
Yeah, it's a really interesting fact pattern, isn't it? And just sort of thinking sort of more broadly about that strategy. So when people are matching their funding to their sort of sources of profit or revenue. That's then kind of matching funding revenues. So you're really left with, I guess, only exposure to profits really from that business. You're kind of matching operating profit to the funding in the same currency. And it's then only sort of net profit that you're left with, sort of net euro profit or whatever that's being generated from that business as a risk.
I would say, yeah. So for financial sponsor, the
Mm.
way they think about it is usually like EBITDA,
Yeah.
kind of like metric,
Yeah.
which in some businesses is straight converted into like cash flows.
Yeah. Yeah. So a significant portion of your financial or your FX risk can just be addressed by capital structure. But then I guess do we see some companies do both, where they address the capital structure, but they still have some residual risk that they address with derivatives?
Correct, because from our experience, each time we have to deal with capital structure analysis,
Mm.
it will create some what we call natural hedge because
Yeah.
the debt is going to take some cash flows or like net exposure from those currency to cover like the cost of debt and sometimes debt repayment.
Yeah.
But it's usually not enough to absorb the full FX exposure. So then you end up with like what we call FX operational hedging.
Mm.
That's usually more a post-closing topic,
Yeah.
but that is important to understand because it might impact like how much you may want to bid for like a particular company if it's heavily exposed in terms of like FX, and you will need to entertain a very expensive like FX program during the life of the asset.
So, what are some of the hedging strategies that we've seen clients employ? And let's focus first on the deal part of it. So, I'm buying a company. I want to hedge
Yeah,
that risk in that. We talked about that sort of 3 to 6 month, 9 month
yeah.
even period that people are looking at. FX IR risk. What kind of tools are people using?
So that's typically the risk or the period we call sign to close
Mhm.
hedging. And given the uncertainty sorry, associated with the just closing and the timing as we discuss, we see most of the time people like looking for some sort of optionality,
Yeah.
either looking at like an option type product, so vanilla option where you have to pay a premium upfront and you get like a sort of insurance, or deal contingent solution,
Yeah.
which doesn't require upfront premium. And I think that's been the big appeal for that product. And just to explain the product, if you have the typical like sign to close FX risk because
Yeah.
you have mismatch between your sources and like uses,
Mhm.
a typical product will be like a deal contingent FX forward that allows you to lock a FX rate where
Yeah.
the settlement of that contract is subject to the underlying M&A closing.
Yeah.
So it gives you the right to walk away from that transaction at no cost
Yeah.
if the deal doesn't close.
Yeah.
And the way the contract is priced, you will trade at like an FX rate that will embed a deal contingent premium to reflect the risk that a bank or a deal contingent provider
Mhm.
offer you that right to walk away from the transaction.
Yeah.
And another nice feature of like those contracts, especially for FX, is as you don't really know the date on which you are going to close,
Mhm.
it's common for the contract to offer like a schedule of dates that allows you to close on like all possible dates until your long stop date, which is quite appealing for our clients. Another thing is those type of contracts have been around for quite a long time, but we've seen a significant pickup in terms of activity over the last decade. You can trade outside FX, you can do interest rates, you can do commodities, you can do inflation.
Yeah.
And there are other contingencies that one can look after, such as like IPO, financial close for project finance,
Yeah.
and in some very specific cases, refinancing.
I mean, it does seem a very attractive product, right? I appreciate that obviously the underlying swap that you're entering into or forward or whatever the nature of the underlying contract is, it is
Yeah.
a higher rate than a vanilla contract, but knowing that you're not going to get to that situation where the deal doesn't close and you're left with a derivative contract that you can't get out of. And maybe if you're hedging, a 500 million deal, your derivative, an FX derivative you could have a 10 million liability. I mean, it could be all kinds of numbers. Actually, it could be huge, right? And having to settle that when the deal's not closing is pretty painful.
And that's a big problem, and why deal contingent has been such like a nice solution for a lot of clients, and also because there is just no upfront cost associated to that. One question for you, Kern, is when we have discussion with clients, especially at the stage where we are discussing capital structure, potential product for hedging, we usually start to see like the beginning of discussion around like hedge accounting. So might be good if you could just give us like a refresh on like financial reporting, and like what are the implications for like clients. And
No, definitely. I mean, I always think about it in terms of taking a big step back and why do we apply hedge accounting in the first place for this type of transaction? And then we can start to talk about, how hedge accounting works and what some of the rules are. But if we think about why you would choose to do it, obviously we've spoken about the economic risk. We've spoken about the fact the derivative can be a big number. Well, the challenge with derivative accounting is that derivatives on your balance sheet, and in our example, maybe you have a 10 million liability on, the purchase of a business in a foreign currency, and that purchase of the business, that's not recognized in your financial statements at all. That's a future transaction, won't come into your financial statements until you do the deal, until it's finalized. But you do have the derivative because you've essentially pre-hedged. That's on your balance sheet. It's a 10 million liability. The other side of that is going through your profit and loss account. This is the default accounting for derivatives. So you make a 10 million loss, and let's say you don't close the deal before the end of your financial year. Then you have to explain to your investors what this 10 million loss relates to. And it really doesn't make any sense because you're actually perfectly hedged. So the story you want to be able to tell is, don't worry, everyone, I'm perfectly hedged. But the story you end up telling in your financial reporting, and I think of financial reporting being the story of the performance of your business. That's what it should be if it's doing its job well. The story that you're telling is that you've got a 10 million loss. So how can you address that? Well, hedge accounting is an optional treatment that changes the default derivative accounting, that gives you an answer that's closer to what you're trying to achieve from a risk management perspective. So if I am able to apply hedge accounting, and you have to qualify, and there's some criteria, and some of them are quite strict, and we can talk about that. But if I am able to apply hedge accounting for that transaction, then I reserve that 10 million loss in my cash flow hedge reserve, and then I don't release it until the transaction occurs, and then I actually release it against the purchase price of that transaction. So when I think about it from a consolidated financial statement standpoint, it actually ends up increasing my transaction price, which means I end up recognizing more goodwill. And that goodwill will only impact the P&L over time as the goodwill is impaired or as you dispose of the subsidiary in the future.
Sometimes with discussion with client, we have this concept of like highly probable transaction. Could you share a bit of light?
That's probably the biggest criteria that we sort of get into with this type of hedge. I'm not going to talk about all of the qualifying criteria of hedge accounting. There is a certain amount of complexity there. You have various sort of hoops, if you like, that you need to jump through to qualify for hedge accounting. But the biggest thing that in this type of deal, because it's probably the biggest area of scrutiny, is going to be you need to have a highly probable future transaction as your hedged item. So if we're talking about the example of we're actually hedging the future purchase, you need to be able to assert that that future purchase is highly probable. A lot of the time, there may be quite a bit of uncertainty about whether that purchase will actually go through. And that may prevent you from being able to apply hedge accounting. So it's not always going to be available in these situations. Sometimes it's not available in the most obvious way, but there may be other routes via which you can apply hedge accounting. So there's always kind of a two-step process. Can we can we apply hedge accounting in the most obvious way? And then the second question, are there other ways in which we can apply hedge accounting which might mitigate the immediate P&L volatility and at least make the story, somewhat more consistent with the risk management story?
For the concept of like highly probable transaction, I came across like an article about a corporate merger acquisition in 2016 when the treasurer was adamant he wanted to achieve hedge accounting for like the deal contingent hedge they were contemplating. And they actually waited for like the shareholder vote to
Yeah.
be out before entering those trades. So is it linked to that nuance of like the shareholder vote would push the transaction from less likely to highly?
I mean, most likely that and you see that kind of situation all the time where you don't have a highly probable forecast transaction at first when you first want to put the hedge on. And there's two ways of approaching that, right? One is you don't put the hedge on because you're not going to get hedge accounting. And the other is to say, well, I put the hedge on. I don't get hedge accounting at first, but there may be a point where I am able to apply hedge accounting, which is still prior to the deal actually occurring, as the probability increases over time. So we see two sort of possibilities there in terms of how people approach that. If there's nothing else they can do to designate that hedge, I guess the first thing I would say is we've talked about black swans. It's kind of rough, right? If a black swan event occurs in that period when you're unhedged, and the only reason for not hedging was because you wanted to be able to tell a better story in your financial statements. That to me is a bit of a tail wagging the dog situation. I mean, ideally, you want to think about what your economic risks are, address them, make sure your deal is going to make sense economically and return long-term value to your investors. That's what financial managers should be held to as a standard. And then hedge accounting is about better telling that story, right? But ultimately, you should get to the story first, and then see how well you can tell it in your financial statements.
Understood. On the hedge accounting, where we are quite close to frame the hedging strategy with client, we often have this, I'm not sure if debate is the right word, but should you frame your decision on the hedge based on the economic benefit that will bring the hedge, or should you frame the decision based on the accounting treatment? So I'm just curious, like, what's the best way to handle those discussions, and is there a way to optimize both so you get the desired outcome?
I would always say, and really kind of consistent with what we were just talking about, I would say solve for the economics first. Then you ask yourself the question, is there any other way of structuring this deal? Like if you do the correct economic deal and it doesn't work for hedge accounting, your first question should then be, is there any other way of structuring this deal which doesn't change the economics or makes a very insignificant difference to the economics, which gets me a better accounting outcome? So if you're not really changing the economics and the accounting's better, then maybe that's preferable, right? But you don't want to fundamentally change an economically good deal, or not do an economically good deal because of an accounting concern. That doesn't seem like the right way around of thinking about it. What you want to do instead is do the right deal economically, and then work with experts. Like ourselves, this is something we often do for our clients. Is we come in and say, okay, you've got the right economic deal. We can help you make sure that you get the best possible accounting outcome for that deal. It might not be perfect, but if you've got the right economic deal, that's what you should be thinking about first. And then we'll get you as good an accounting outcome as we can.
Yeah, and I find in those situations, actually, your team is doing a lot of education on the client side because I don't know if those are scary concept or like complex concept, but it's what we see most of the time. Are there any recent accounting development that our client should be aware when it comes to like hedging in those scenarios?
I mean, I don't think there's been significant change very recently. What I would say is that it sometimes takes a while for the marketplace to catch up with changes because even if a standard has been around for 7, 8 years, as is the case with, if we think about the most recent sort of IFRS hedging accounting standards and US GAAP hedge accounting standards, we're talking about standards that have been in place for 8 years plus. Um, those kind of time periods, you would think that people have got used to all of the requirements of the new standard. But the reality is people don't hedge very often, right? So they might be used to the things that are in IFRS 9, for example, are doing every day, but they maybe don't hedge a future forecast transaction of purchasing a business every day. They might not have done that for a decade, right? So what we sometimes see is people come to us and say, "Oh, we can't do options because they don't work for accounting under IFRS."
And we had actually a recent case
Mm,
where I think your team was involved, where we discussed like time value of like options on a
yeah,
pre-hedging scenario, which I agree. I think the client had the old framework in mind,
yeah.
where there is now a much better framework to look after those solutions.
Yeah, and I think sometimes as well, you can get confusion from, there's a different framework under UK GAAP than there is under IFRS. So people might be used to one framework and the rules around options are different under UK GAAP than they are under IFRS. But the good news is that under IFRS, there is now a good answer for the time value of an option that you're using in a transaction like this, where you would be able to defer it along with the rest of the value of the product in the way we were talking about for that sort of cash flow hedge of a future forecast business purchase for FX risk. And I guess when we've closed an M&A transaction, we've spoken quite a bit about getting to closure and the economic risks you have there. You did touch on operational hedging when we were talking about EBITDA earlier. What are the main things that people need to think about when the transaction is closed in terms of hedging or mitigating financial risk?
So that's correct. Like when you close, it's not the end of the game. It's really like beginning of the story for the investor, or like corporate buying the company. So what we see on our side is just to make sure you have, especially in businesses with multiple like currency exposure,
Mm,
that you have very good visibility on like your data, and see if you have like any policy that is in place that needs to be revised following like potentially like a new capital structure, or like a new ownership, or like being integrated from within a larger group. All those things matter in terms of like processes. Also system could be an important factor. I'm sure you will cover like the accounting. What we find is, as I explained before, on the capital structure, it's usually doesn't mitigate 100% of the FX risk. So you need to have a plan to address the FX risk, but it could also be like commodity risk, which is also an ongoing risk. So making sure you have the processes, the policies, the tool to monitor your exposure, and data is critical. So it reminds me a case where maybe 6 or 7 years ago, we were hired by private equity fund post-closing to look after FX operational hedging for one of their portfolio company. And when we did a big deep dive into their FX exposure, which included like lots of intercompany transactions, subsidiaries, the data was not super clean. We discovered that they took like the debt for the business, not in the optimal currency. And we had to undo everything that was done just by picking the wrong currency for the debt. So it's really critical to understand, I guess, the data. Not sure what you see on the accounting when you have those situations, either of like business combination or new owner.
I mean, we certainly, just going back to your point about data, I think data remains this huge challenge. And from a sort of technology standpoint, I sometimes think it's the biggest challenge, right? Because we live in this world where we have these amazing artificial intelligence tools that people are always talking about, right? It's a buzzword, right? And we do have better and better software, but software can only really help you if you have a complete data set and you have reliable data. I'm sure we will get to a point where we have technology tools that are better and better at gathering data. But at the moment, it does remain a big challenge for a lot of our clients that if you're talking about a business that, and we work with many accounting clients that are like this, where they have maybe 100 operating companies all over the world. Maybe they're exposed to 20 different currencies. When you go to each individual operating company, it has its own FX exposures tracked in, and it might be in its own accounting system, which is different from the accounting system that's used centrally, or it might be tracked in the most famous accounting system in the world, which is, Excel, so or some other spreadsheet, right? So you have all of this variability in the quality of the data. In some cases, the data just may not be reliable. But even if it is reliable, there's a challenge in getting it all together and making sure that you have data that you can look at centrally and make informed decisions. So I do think that sometimes it's hard to get to the right accounting answer because the data quality actually slows that process down, or in some cases leaves clients really unsure of what the right decision is. And this is exacerbated by if you're thinking about hedging, operationally, you're thinking about hedging, not the past, right? You're thinking about hedging future revenues. So you're going around the business and asking them, what do you think your exposures are going to be over the next 6 months or over the next 12 months, or sometimes the next 18 months, depending on what interval you're looking at in the program. And that's really challenging to get that good quality data for those kind of forecasts.
And where we see additional attention is because cash management is closely related with FX forecasts and like exposure and like hedging.
Yeah.
And in a world where rates are much higher, having those things sorted is very important for businesses.
And then from a more broad accounting perspective, that post acquisition accounting is actually where, there's complexity pre-acquisition as well, but you get probably more hedge accounting complexity starting to come in post-acquisition because it depends on the nature of the business. But if we think about corporate M&A, where you're buying a business and integrating it into your business, that's a really interesting situation from an accounting perspective. First, there's an operational challenge. One business will have its legacy. We just talked about data. It will have its legacy processes for collecting data, may have its legacy accounting systems. So you actually have an operational integration to get through. But if you think about it from an accounting perspective, what we often see is, let's say we have a US business acquiring a European business. The US business might be reporting under US GAAP. The European business might need to file its own separate financial statements, which investors are probably not going to pay a lot of attention to, but might be really important in terms of tax. Might also be really important if one of the things you're thinking about possibly doing with that business is spinning it out in the future. So even though you're not reporting that business externally that much at the moment, you might be thinking about, well, we might want to report this business externally in the future if we want to spin it out or have a subsequent transaction. So you have this separate business reporting under IFRS. Maybe it has some of its own hedges. Maybe you've added some hedges as part of the acquisition. But the hedges that it already had in place, it's reporting under IFRS, and it will be reporting for those hedges from trade date. So hedge accounting might have been designated at trade date under IFRS. When you purchase that business, you will, and let's say you purchased the business 2 years after those hedges were originally traded. You would then, in your US GAAP consolidated financial statements of the US purchaser, you would be applying hedge accounting. That's assuming you're applying hedge accounting at both levels. You would be applying hedge accounting from acquisition date, not for the full life of the hedges, because you didn't have them for the full life. That means they have a non-zero value when you purchase them, which of course makes the hedge accounting more complex. Why wouldn't it? So you have more complex hedge accounting under a different gap, with a different starting point. So the numbers are different. Your cash flow hedge reserve is different because there's a different starting point. The amount that you ultimately end up releasing as a hedge accounting reclass will be different because you had a different starting point. So you have this difference between these two sets of books that you're running. These kind of things cause a lot of complexity. It's hard for people to manage. So just sometimes managing the complexity is something that we find we have to help clients with these type of M&A transactions when you're thinking about the post-acquisition running of the business.
You mentioned the case of like acquiring like a foreign entity for accounting. Are there any other like cases that are relevant?
Yeah, when we think about the different strategies that we might see economically and then how they play out for accounting, things that might feel quite similar from a hedging perspective can lead to quite different accounting results. So we've taken probably the most simplistic example in terms of talking about a future purchase of a business and how that works for. We use the example of cash flow hedge accounting under IFRS. So that's a fact pattern that's relatively easy to talk to. But one that might feel quite similar economically is, say, I've got a GBP entity, a GBP functional currency entity. It's purchasing another GBP business. No FX risk, you might say, but actually, it's more efficient for them to borrow in euros. And what they've decided to do is borrow in euros, then they'll switch those back to pounds once they've borrowed them, and invest in the GBP business. So their risk is they have this euro borrowing that they haven't entered into yet. So it's a future euro borrowing. From a hedging perspective, that might feel quite a similar kind of hedging transaction. But actually, from a hedge accounting perspective, it's different because there are rules around hedging, a future debt issuance for FX risk that basically just say no. No, you can't do that. You don't have an exposure to FX risk until that foreign currency debt is on your balance sheet. So you can't hedge it yet. You can't hedge it as a sort of pre-hedge. So for hedge accounting. So that does create this complexity of if I'm looking at a transaction that's structured that way, probably feels very similar economically, but you get a very different accounting result. So in those cases, you would have to think about, okay, what other ways can I designate this to try and mitigate the P&L volatility that might arise? The other ones that we see quite frequently are where people know they're going to have to borrow a significant amount of money for a transaction, and whatever currency that's in, they might want to hedge the interest rate risk. So it might be, a GBP entity borrowing in GBP. That's probably what we see most frequently. And they just want to hedge the interest rate risk on that. So they're going to enter into a SONIA swap, and that SONIA swap, whether it's forward starting SONIA swap, or it might even be a deal-contingent SONIA swap, as long as entering into that borrowing is considered highly probable, and we've touched on that already, then you would be able to designate that swap for hedge accounting from the date that you traded it, as long as you meet that highly probable test. So yeah, there's a few different fact patterns, and I've only touched really there on some of the most common ones. There are obviously some really bespoke fact patterns that we see out there as well.
Kern, in terms of recent trend for accounting, do you see anything worth mentioning?
Yeah, I think one of the biggest things that we've seen is, and this is a reasonably long-term trend, I would say, and again, we talked about how there haven't been massive changes in accounting standards recently, but perhaps people are still getting up to speed with the most recent change of standards, sort of 8 years ago or so, where we saw, particularly under IFRS, more complexity around accounting for cross-currency swaps. And under US GAAP, we didn't see necessarily that much more complexity with accounting for cross-currency swaps, but we did see a change of model in how you account for particularly for cross-currency swap net investment hedges, which create quite a favorable way of accounting for certain carry trades. So both of those things have been trends. We've seen a lot of cross-currency swaps with hedge accounting applied to them for different reasons. Particularly here in Europe under IFRS, we've seen a lot of people needing help with cross-currency swaps because of the complexity of the new accounting model. You have to separate out a component of the hedge as cross-currency basis, which is essentially a liquidity charge, as part of the pricing of a cross-currency swap. And the way I think about that, as in my sort of accountant's way of thinking about things, is when we say it's a liquidity charge, I'm really sort of saying, well, dollar is the world's favorite currency, right? And it's kind of, when you think about what the cross-currency basis is, you're really thinking about how much more would I rather have dollars versus this currency that's on the other side.
Currency premium.
Yeah, it's a currency liquidity premium really that's built into the product. So that drives a lot of the cross-currency basis that we see, but it's quite a complex pricing feature that is a component of the valuation of a cross-currency swap, and a lot of people struggle to separate that out. So this is where we start to get into perhaps one of the other trends that we've started to see, which is an increasing need for people want financial reporting numbers quicker. They want more controls over their data. So, people want those outcomes, and the only really way to get those outcomes is good technology. So we're definitely seeing people wanting more in the way of accounting technology, wanting more in the way of valuation technology. So we do have our own hedge accounting platform that we offer to clients. We definitely see more people being interested in that, more people being interested in our valuations as well. So being able to offer valuations to clients, daily valuations to clients within our software platform, for example, those kind of things are increasingly important. And that's increasingly important, I think, across the place. It's not just in terms of derivative accounting, but I think more broadly in terms of people's accounting needs. There's just this expectation in the marketplace that people have robust data with really good high quality controls over it, and they're able to get that really quickly. And I think that drives accounting towards a greater reliance on technology.
And we've seen a similar trend on our side at two levels. So FX operational hedging actually now is heavily reliant on like good technology, because you need to make quick decision and like make sure you can optimize pricing and have good visibility on your forecast. But similarly, like looking at very large sponsor, when they have like huge asset of portfolio, become more and more difficult to have like a global view of like what's the exposure, what is hedged, what is unhedged, when are my hedges are going to expire, when my debt is due like to be refinanced. So all those type of like dashboard and market intelligence or business intelligence is very valuable for clients, and they looked at like Chatham solution on the technology side.
And actually, that's so glad you mentioned that. But that's something that our clients have seen very valuable on the accounting side. Is if they're using our exposure management tools, it really integrates seamlessly into the accounting technology. So you can have really this sort of cradle to grave solution where a client has their exposures, that then helps them make hedging decisions around hedging their operational hedges. It will actually recommend hedges to them. They can integrate that with an execution platform, and they can send that over and get that executed in the marketplace. Then if they integrate with that platform, that will come back into the system. And will flow through for accounting, and you'll start to see hedges being designated and accounting being kicked off automatically in the system. So I think that's definitely the future, and we're starting to see that with operational FX hedging, of this real integration between different technology tools to give a cohesive solution for clients. That concludes this episode of Expert Conversations Beyond. We would love it if you would subscribe on Apple, YouTube, or Spotify to catch up on past episodes and also be notified of future episodes as well.
We would appreciate your feedback, and if you would like to discuss in more detail some of the topic we covered today, or share some ideas to improve your listening experience, you can use the link in the show notes.
Thanks again for tuning in.
Thank you.